Everybody. Sometimes people ask me the difference between putting money in a bank deposit and owning bank shares. So let's talk about it. So let's pretend that we're going to make a deposit to a financial institution. This illustration will be as if it was in a taxable account. And to start with, we'll buy ourselves a 5-year GIC, and let's assume the rate at 2.5% interest. And the first thing you need to know is that in Canada, as a Canadian, you're taxed 3 ways on your investments. You can be taxed as interest, as capital gains, or dividends. Interest draws the worst tax consequence, where capital gains is less, and the most favorable is dividends. So now that we've got our GIC, let's look at tax. Assume a rate of 49.8%, top marginal tax rate means we're going to pay tax on that 2.5 of 1.25%. And something often people never think about is the inflation rate. This is the cost of living or erosion of your purchasing power. That's a constant. And in Canada, we refer to that as the CPI rate, or Canadian inflation rate, which in 2018 was about 2.44%. However, CPI does not include food or energy in its calculation. So I often joke with people that if you want a real idea of what your inflation rate is, go visit the produce section at your local grocery store and you'll get a better idea. So 5-year GIC at 2.5 less the 1.25 say for tax, 2.44 last year's inflation rate, we have a negative rate of return. Over the long term, what this does is it creates not only a negative rate of return, but basically it's going broke safely. So as an alternative, let's see what it looks like if we were to just become owners of the bank. And that means that we own shares. So I'm going to use Bank of Nova Scotia stock as of June 12th. The dividend was 4.96%. So you can see right away that the amount you get paid is quite a bit higher. And that pays quarterly as a dividend. Tax, same thing. We get taxed, but you can see it's at a lower rate. And that's because Canadian corporations, when we invest in them, the government effectively favors us. They give us what's called a dividend tax credit, and for doing so. And that is a most favorable tax rate on investment income. We still have CPI, or inflation, to deal with, and that's 2.44. I'm using last year's number again. And we end up with a positive return of 0.96. But the difference here is that the deposit, while guaranteed, can never grow beyond that, where the share ownership has growth potential. This is a chart of the Bank of Nova Scotia for the last 5 years, and you can see here that in that 5-year period, the stock's gone from about $57 to $70.22. This little dip down here in the end of 2015, early 16 was a market correction. You can see it didn't really last too long, but not bad growth. Here we're looking at a lot further, but back about 23 years in 1996, right back up to today at 70.22. This dip here is the financial crisis in 2008. To kind of create some perspective, this correction was the second worst correction in the last 100 years. All banks dropped about 50% in Canada. They didn't cut their dividends, and Canadian banks at the time were deemed to be amongst the most safe in the world because they're regulated. And so really this whole event really lasted, I guess, about a year and a half or so until they recovered. And so that's the growth potential that has occurred certainly over the last 23 years. The past isn't any guarantee of the future, but gives you an idea how this bank stock's performed. So that's the difference between being a depositor at a financial institution and owning the shares, becoming a partial owner of a financial institution. If you have any questions, please feel free to give us a call.